we see this opportunity that there's a huge shortage, and we'd like to help out with the shortage and bring more supply.
Single-family homes are currently the most unaffordable they've been in several decades. Build-to-rent might be the answer to America's growing housing crisis. To discuss the ins and outs of this cutting-edge real estate strategy, we brought on Flint Jamison. Flint's a former aerospace engineer turned real estate investor and the founder of Vestus Capital. Keep listening to find out more about build-to-rent, including why institutional investors are spending billions to buy these projects before they're even completely built. In March 2023, there were nearly 44,700 new build-to-rent units under construction, and that was 3 times more than 2022. The build-to-rent occupancy is also 97%, which is slightly higher than the 95% occupancy rate for multifamily. And so all that's to say that build-to-rent has been this new, exciting, strong investment strategy that has been really just taking records left and right. And I believe that its outlook is really bright. But for anyone that isn't familiar with build-to-rent, can you just provide some context and define what that business model looks like?
Yeah, gosh, we could go back in time and history and talk about it. Built-to-rent's been around actually a while, but I'll skip that. Yes, but it is a new thing, and maybe I'll hit on this point. I'm going to screw up this quote, but at one point, Warren Buffett said something along the lines of, if you can find me a way to buy 1,000 single family homes and manage them all efficiently, I will invest. And so BlackRock, and I don't remember the date this was. I think this was in the 20 teens, like 2012-ish. BlackRock turned around and was like, you know what, this might be a good idea where we can go build single family communities and just rent out the homes, and then you have everything together versus your standard portfolio of single family homes is, strewn across cities. It's not that efficient. So why not just build a community? Now, taking this a step further, the reason why it's such a hot asset class right now, institutions are pumping billions of dollars into investing into built-to-rent communities, but they don't build. So the reason is, one, after 2008, builders stopped building starter homes, the small 1,200, 1,500, 1,800 square foot homes, because the margin for builders to build those and sell them was slim. So they all started making bigger homes to get bigger margins. And now we have all of these new millennials in the peak family building years trying to move out of apartments into houses. The housing prices are going up. Interest rates aren't helping. And so the challenge is there's, one, not enough housing supply. Two, house costs are so high that people wanting to move into a house can't afford them. So the best compromise became these built-to-rent communities where a builder can build an entire property, 160 units, 240 units, whatever it may be, and sell it as one big commercial property where they get their margin, but they're actually building a bunch of, it's just cookie cutter homes that are smaller starter homes. So it's really great for the builder. It offers this awesome compromise for the millennials and hell, even the empty nesters that want to get out of their house and move closer to their grandchildren. There's just a really great market demand for built to rent, and institutions want to buy. So where we come in is we are the builders.
That's awesome. I appreciate that. That's a really good explanation and overview. And I'm glad you touched on and mentioned demand, because that's something that I wanted to dive into. I saw a stat, according to the National Multifamily Housing Council, 44.1 million American households were renters. And so I know in the past and in recent headlines, there's this talk about the affordable housing crisis, which you mentioned, but also the lack of housing, the shortage, and the rising cost of it. There's that sentiment that the U.S. is becoming a renter nation. And so I wanted to know, do you agree with that sentiment? And also, if so, what does that say for demand for build to rent?
I can't argue against the renter nation part. I think it would be stupid for me to come up with reasons for not. And really, it all comes back to the basics, economics 101, supply and demand. And the challenge is when the supply is really short, investors are always finding opportunities, and investors are the ones that can afford to buy. And then all of a sudden there's this big shift into, there's a lot of rental homes. There's a lot of rental properties that are now being rented out to people. But on the flip side, what's really interesting is they're starting to see there's a growing population of people that don't want to buy. They want to have that lock and leave culture. They want to be able to pick up and move locations without the hassles of owning a property, buying and selling a property.
No, absolutely. I mean, like I said, we've been hearing about this trend going on and it's only getting worse. So I imagine that build to rent is going to become an increasingly more demand as we move forward. And we've also been involved in multifamily syndications, and that's something that we're involved in. And I've heard you reference these apparent similarities and overlaps between these two different kinds of investment strategies. And I was hoping you could dive into that. One that came to mind that I was really fascinated by was the similarities in the management style. So if you want to dive into that, that'd be awesome. But are there any other ones that aren't maybe so obvious?
Yeah, just between the built to rent and a apartment multifamily syndication. So painting a slightly different picture here is what we do. This is new development. And new development isn't new to syndications. There's a lot of syndicators out there that are doing new development on apartment buildings, including myself, actually, as an LP. But the way we got into this was the interest rates started going up. We see this opportunity that there's a huge shortage, and we'd like to help out with the shortage and bring more supply. So what we did as a syndication group, who is essentially, you can view us as the financial arm, because we go find a housing developer. We ourselves, I'm not going to learn how to be a developer and build homes and manage, and that would take me years to get that experience. So we go find a developer who's got 30 years experience, who understands how to get all the entitlements into place, work with the city with all the permits, approvals, work with the engineering teams to develop the engineering for the property. Right? There's such a massive amount of work and knowledge, tribal knowledge and experience that we have to team up with. And so we start talking to these guys, and they're like, "Yeah, this would be great. I would love to build an entire community and make it commercial." And so that's how it started. Syndication group marries with a developer.
Mm-hmm.
And then from a management side, these built to rent communities will have on-site property management and maintenance. The difference here is rather than tenants staying in an apartment, they're in a single family house with a front yard and backyard. There are amenities. We have ponds, we have a pool, we have dog park. We got all the amenities of a Class A multifamily property. So to a certain extent, there's a lot that's the same. The maintenance side is a little different because you have single family homes. You are going to have to mow lawns, but this is part of the incentive for people who want to get out of an apartment. And the empty nesters, they don't want to mow their lawn anymore. It is a lock and leave culture. Back to that term. I can just lock and go on vacation to Europe for 3 months and my house is taken care of.
I know that market selection is a factor that every real estate investor has to pay attention to. And of course, that's like just one of the essential pillars of investment criteria. But since build to rent is such a unique strategy, I wonder if there's any certain criteria or considerations that build to rent investors need to look at. Assuming a market is a good single family rental market, is there any step you have to go beyond that to make sure that it is
Yeah.
suitable for build to rent?
Now, I guess I don't have enough experience to say if it's a good single family to sell market versus a build to rent market from a developer perspective. But the biggest thing is when you get into development, there's a culture out there that's the NIMBY culture, not in my backyard, right? Because you can go in there and say, there's this big piece of property, 10 acres, I want to put a bunch of homes on it. And then you go to the city council and say, I'd like to build. And then the locals come in and say, no, not in my backyard. And they vote it down. And you could have bought a piece of land, pumped a bunch of money into it just to be voted down. So the biggest thing when it comes to development, period, is knowing, is that city council going to work in your favor?
Mm-hmm.
So this is part of where we were really happy to partner with a builder who he builds within 4 hours radius of where he lives. So he knows all the cities in that area. He actually emails the city governor. I mean, he is really tight knit with these guys, and he knows that he can get things approved. And to the next step, a lot of people, I'm going to take this one step further. A lot of people view development as riskier, which in some scenarios is absolutely true. And so part of what we did is the syndication and the builder bought the land and entitled it. That is, we call that phase one out of the three phases. You buy land, entitle it, you do the horizontal streets, utilities, sidewalks, and then the phase three is the vertical. You build the houses. So phase one is the most risky because that's where you can get voted down. That's where core samples can say, oh, it's going to cost you this much more. Environmental studies, all of that. So what we did is syndication group and the builder bought and entitled the land. So we're bringing in investors at the horizontal phase where we're already approved and permitted and ready to go.
I'm so glad you mentioned that not in my neighborhood mentality and sentiment, because I've heard you talk about that before in another interview. And I wanted to know, I mean, I've heard that tendency for communities. I've heard about that as well in the context of affordable housing developments. But I'm just curious, is there a good reason for somebody to maybe oppose a build to rent community? Like, why would a neighbor not want that?
I think it's just a lot of people just don't want more houses and congestion. But yes, you're right. So affordable housing versus what we're doing, um, I would consider them two different things. Yes, we're building starter homes, but we are building really nice starter homes. We aren't building like a class B built to rent property or class C built to rent property. We're doing class A plus. We're having hard surfaces. We have all the amenities, really nice, pretty property with. So we plan on bringing in premium, high paying rent tenants. Um, I guess I never really got into that discussion with the team about um, if we had proposed like a lower income level class B property there, would there have been more fight? I don't know, but I think it does help that we say, hey, we're planning on bringing in a higher income level clientele.
That makes sense about the congestion side of things. To move on, earlier you touched on the business model regarding build to rent. Can you provide more context as to how long that timeline looks from when you, I don't even know where the beginning would be, but when you start, let's say, getting identifying the land, how long does it take to get to that point where you're ready to move in a resident?
Yeah, so back to the risk factor when you get into development, the timelines are very squishy, including what we're seeing right now on three properties. Um, so to put it in perspective, yeah, we get the land, we entitle it. That takes X amount of time. But when we plan on bringing investors in is when we're permitted and we're ready to go. So to paint that simple picture, we plan on doing 15 starts a month. So with these houses, we're planning on starting 15 a month, and the next month another 15. And after, I'm gonna start losing my numbers here off the top of my head, but I think after 6 to 9 months, those first set of houses will be done. So we'll have 15 finishes, and at some point, we can just start filling the houses as we're continuing to build the community. So to put this in a more global perspective, 160 unit property, we plan on being completely stabilized by year 3 once we
Nice.
start the horizontal and infrastructure phase. And then we plan on holding it stabilized for a year and then sell. So that 160 unit is the full cycle for an investor is 4 years. We have another 240 unit property that's going to stretch us out to 5 years. But the plan is to sell at the end. Taking this one step further, you're probably going to ask exit strategies. Built to rent is great from an exit strategy standpoint. We have a bunch of single family homes. The goal is to sell it as one big commercial property. However, if for some reason the economy changes and forces us into a different type of exit strategy, we have single family homes. I think plan B would be, hey, we already have a property management in place. We already have the infrastructure for a rental community. Maybe we parcel these off and say, hey, investors, you want to buy 5 turnkey homes or 10 turnkey homes, right? Sell them off that way. And I think option C is just partner with a real estate agent and start selling them off individually as needed. But we have more options for exit than you do with an apartment building.
Yeah, thank you for expanding on that. That makes a lot of sense. And I know you raise capital from passive investors on these deals. And I'm a big believer that while real estate overall is a good investment, not every investment is good for every investor. And
Yes.
I know that there's probably different benefits to these types of investments, built to rent, compared to other real estate investments. So I wanted to know who's the ideal investor in a built to rent
Yeah.
deal, and who shouldn't invest in a built to rent.
Yeah. So the biggest key difference is no cash flow so we'll go back to that 160 unit. Up until we stabilize at year 3, we won't have any cash flow. So you need to just be okay with that. It's a long-term investment. However, on the flip side, with developments, there's always planned to be a bigger upside than you would see on a value add. So we typically target on this 160 unit, we're targeting 21 to 25% IRR versus your standard value add, which is on average 15 to 20. So there is a little bit more upside at the end. You just have to be careful with the cash flow. Now, the thing I always tell investors, I still do value add apartment buildings. I just did one. I did a 94 unit townhome in Columbus. That one cash flows, but if you put in $100,000 over the 5 years, you might get cash flow to the tune of $15,000 over 5 years. So no matter what, your cash flow isn't staggering, and you're not going to live off that cash flow. It does give you peace of mind that there is something coming in. The property's still cash flowing. It's still generating revenue, right? That's the lesser risk. But you put things in perspective. Do you need that $15,000 over 5 years? Or do you want to invest in a development that has potential to create a bigger multiple for your money?
This is like just another idea of I know you said development is seen as more risky generally, and you mentioned that community factor, that could be a risk factor as well. Are there any other risks that investors should be aware of when it comes to built to
Yeah.
rent?
And some of these things are common when you do a value add. It comes down to cost of materials and labor shortages. Those impact both. I think that they would impact development more so because you still have to build. Whereas a value add, if you slow down, you can still at least rent out an older legacy apartment. So that's really the biggest one is knowing material costs and labor.
Another factor that you said is in general, like if developments are typically seen as more risky, and this is technically a development, what do you say to that objection of, oh, this is a development and it's risky?
Yeah, and that's the thing. I've done a lot of soul searching on this, and you think across the board. Right now, societal norms is put your money in a 401k and throw it into the Wall Street, and that's like the best way to grow wealth. In reality, those of us in real estate are starting to see the light, and we're like, well, multifamily is actually, it's called an alternative asset because we've been trained as a society, probably from the big financial institutions, that it's an alternative investment when it's really a real investment. It's a real tangible investment, and it's more stable than Wall Street. So at some point, risk is ignorance, and we all have ignorance in the things we don't know. The wealthy are investing in fine art. I mean, to me, I'm like, whoa, that's super risky. But there's some massive tax advantages if you go buy a really expensive piece of art and put it on your wall. I mean, there's benefits there, and there's probably not high risk if you know what you're doing. So it really comes back to, do you know what you're really getting into and investing in? Because your risk levels are really subjective to what you know.
That's so
And I
true.
think the same thing with development.
That is so true. I mean, I've heard multiple people say that education is one of the best ways to mitigate risk. And like you said, a lot of times people are taken advantage of because they're just not sure what they're investing in or if it's even a legitimate investment at all.
And to add to this, what's funny is everyone says, oh, development's too risky. But everything you live in, shop in, entertain in, everything that we have built is built by a developer. And if development was so risky, why has so much been developed? It's not that risky. You just got to know a little bit more.
Another factor, I guess, a risk factor that I've been talking about a lot with guests that I've brought on to the podcast was economic recessions or a downturn. And you mentioned the way that a build to rent development project might pivot in the event of a downturn. But could you expand on how an economic downturn would impact a build to rent community?
To be honest, I have no idea. I just know that we have 3 different exit strategies. I've been trying to think. The only way that I foresee build to rent being sold off as individual homes is if the supply of homes skyrockets. But we are not seeing that. I mean, there's going to be so much demand for renters who can't afford houses because the supply is too low. Thus, demand goes up. Thus, the price goes up. I mean, it really comes back to that. With interest rates being high, it's just compounding the challenge more for people who want to buy.
COVID was another example of an interesting time where the entire real estate market was definitely shaken up. And I know, particularly on the construction side of things, supply chain bottlenecks put a lot of delays in business plan implementation and just renovation project timelines. So even now, things have somewhat recovered from that, but we're still experiencing high labor costs and high costs of construction. Has that impacted the build to rent industry, and how have you guys kind of mitigated those factors?
The cost of materials has actually normalized back to pre-COVID. Costs of labor and challenges of hiring labor, it's still it's still there, but that goes across the board, even with value add too. But as I was just hearing recently that there are less development projects going, which is true, and because there's less development projects going, there's actually more labor available. So that labor challenge has actually receded as well for us. But to your point, because we have this recent history of the pandemic and things spiking, we made sure when we underwrote to cover for those rainy days or those big challenges if things were start to spike. We're putting some good reserves in place for that.
Yeah, and there seems to be two schools of thought within the real estate industry regarding how you approach a particular investment strategy or vehicle. And some people will say, I know Andrew Carnegie said, when you're beginning your investment journey, you put all your eggs in one basket and just watch it like a hawk. I think that was him. I butchered it, but that's one perspective. And there's this other philosophy of diversification from the beginning. But I wanted to know, because obviously build to rent is a very unique strategy, but it's still a development. And you said it's not very cash flow heavy. Is this something that is viable, or does it make sense for someone to really put all their eggs in the build to rent basket, or is this something that should be kind of like a supplemental investment along with their other investments? And of course, this is not financial advice. This is
Yeah, it's true. Disclaimer: we're not financial planners or advisors or tax consultants or any of the above. That philosophy has recently come across my table. So there's a guy, Garrett Gunderson. He wrote the book Killing Sacred Cows, which is just incredible. And he's got a company called Wealth Factory. But they absolutely pitch diversification is actually the slowest path to growing wealth,
wow.
because when you diversify a whole bunch, you don't have enough knowledge in any of these to become an expert and to grow your wealth. So, but let me temper that with a little bit of like for us, we can be 100% real estate, commercial real estate, because we understand it. But within commercial real estate, you have multifamily, built to rent, industrial, retail, self storage. And a lot of these can be very transferable from what we know. So you can still diversify. You can diversify from Dallas Fort Worth to Atlanta. There's still ways you can diversify within your expertise of not throwing your money into crypto, Wall Street, real estate, fine art. So when it comes back to, sorry, I'm taking this the long route, giving you my philosophy. So build to rent, I absolutely think sticking within the real estate realm, you should diversify. Get some development, because it is riskier.
Mm-hmm.
And then there is multifamily, but even amongst multifamily, class A, B, and C, then there's self-storage. I love it all. And they all provide cash flow differently or returns differently. So I always encourage, and that's what actually I do as a capital raiser. I bring a diversified portfolio of real estate assets to my investors.
Yeah. And you mentioned the high interest rates. I'm just curious, you might have already touched on this, but how have these, because I know this isn't necessarily like historically all-time highs in terms of the interest rates, but I think it's that rate of change. How did that rate of increase impact the build to rent space?
It absolutely impacted us because rates are higher, but luckily the deal still works with the rates we can get. Now, here's the interesting thing. The construction loans, lenders love build to rent. Once again, this comes back to the big financial institutions are seeing the massive demand for build to rent and they want to own them. They don't build them. But these institutions also lend construction loans. So they love our projects, and we do get um, a lot of products that lenders are really willing to work
Mhm.
with us on.
Yeah.
So, but yes, interest rates are still higher.
Like we mentioned earlier, you of course raise capital from passive investors, and you also have that multifamily background. And so I'm assuming that the minimum investment is relatively the same. Is that the case, or are they different?
Yep, that's 50,000 is
Okay.
our minimum.
Okay, because like with a multifamily complex, right? Like, no investor is going to walk up in a passive investor and say that's my unit. Like that's what is corresponding to their investment. Whereas with build to rent, I wonder is there a certain house that the investor is like able to identify, or do they have an ownership in the community as a whole?
Yeah, you have to view the property as one big commercial property. So you own the whole thing. We essentially, even though it's single family homes, it is one entity. It's one LLC, and we plan on selling the one LLC to a buyer.
In another interview you did, you mentioned this really interesting trend of these larger institutional groups coming in and buying these build to rent projects before they're even done. I mean, I get it, but can you expand on what incentive or what is the reasoning behind these groups coming in and buying a project that isn't even finished,
Yeah.
and what does that say about the build to rent industry looking forward?
So this is the most exciting part: is at any given point in time, we could get unsolicited offers. Um, I have a friend who's done some build to rent, and they got their investors in at the land level. So they went through all the entitlements and engineering. Right, you're sitting there, and dirt's not even touched. Everything's on paper. When they got it permitted, they got two unsolicited offers. They essentially, within 18 months, doubled their investors' money because two big institutions came in and wanted it. Now, the play here for the institutions is, hey, you guys did all the legwork. It got permitted. There's no NIMBY that canceled you, and you have the builders and contractors in place. They just say, hey, we want to buy it, and we're just going to contract the builder, and then all the investors basically are like, thank you, thanks for all the money. Other people have been bought out 50% built. I mean, because everything's already in place and moving. So it kind of behooves some of these institutions to get in early before there's more competition, possibly at when it's stabilized.
I think I've already asked some like a question similar to this, but the word appreciation just keeps coming to mind because it does seem like Robert Kiyosaki he defines the difference between gambling and investing in in real estate as cash flowing property that you're not necessarily banking on the value going up versus with other types of investors, they'll go to a single family house and just buy it that doesn't cash flow, or sometimes it's even negative cash flowing, and they'll just be hoping that they'll ride the market. But I know for a fact in the multifamily space, we're seeing people realize, oh, like right now, operations is essential because you can no longer really rely on the market to save you. This is mainly just a conversation started more than a question. Like, what is your perspective on that? And maybe the accusation of someone saying this is an appreciation gambling play versus really investing.
Yeah. So with this is a great point. The thing I love about development, you can compare this to, uh, say you go get an apple seed for 1 penny. You plant that in the ground and it grows a tree, and now you can sell off hundreds of apples a year for $1 a piece or whatever. Um, we're essentially doing the same thing. We're putting in a little bit amount of money. I mean, it's still a lot. We're putting in
Yeah.
money to build an asset that's worth way more. Similar to value add, right? In value add, we don't count on appreciation. We count on the forced appreciation where
Mhm.
we increase the income level. And so that's a similar philosophy with us. We're creating something from nothing that's worth more than what we paid for. Yeah, we absolutely don't plan on appreciation, but if appreciation helps us there, it's good. And then actually, we should talk about depreciation while we're there. We do get depreciation on each phase. Um, there's only so much you can depreciate when you have roads and sidewalks, but throughout each phase, we will get accelerated depreciation. And then towards the end, we'll get even more depreciation once we have more and more to write off. So,
Like, where do you see this build to rent space going? Do you think this is just a phase or a fad, like the AI, like or the .com bubble? Like, do you think that this is going to burst, or do you see this being something that's here to stay, and make a case for it?
yeah, it's absolutely here to stay. Mostly because the um, the housing shortage is driving it, and we have this massive millennial population followed by the zennials who all need housing, and the older generations are staying in their homes longer and longer and longer. There are those empty nesters that do go towards the built to rent properties, but we're seeing that more people are sitting on their properties. Like right now, I don't want to sell my home. I got a low interest rate. Uh, I think it's here to stay, especially because the renter culture is happening. The value of houses is skyrocketing. This is just such a great solution. And the institutions, like I said, there's hundreds of billions of dollars targeted because that's the trend they're seeing.
I just got curious about the renter resident experience. I know at a multifamily property we offer amenities and that community feel. I'm assuming that's found at these properties, at these communities as well. Can you provide some expansion on that? Like, what kind of amenities are offered, and what are the benefits to the resident themselves?
Yeah, so it's really family friendly type of property because we are going to have the pool, we will have the dog parks, we will have walking trails and ponds on our properties. There's other things where you can put in co-working spaces. You can I've heard of larger properties putting in actual daycares. I mean, you just tailor to the market you're building to. You can put all sorts of really great amenities to tailor to these families, these young families that are targeting these properties. The best place is investwithflint.com. It'll actually take you to my site, Vestus Capital. Lots of resources there. Then if you want to engage and jam with me on social, I'm on LinkedIn, just /Flint Jamison.